Welcome to The Explainer. Today we're diving deep into a really crucial provision, especially for anyone in the mining and mineral sector. We're talking about Section 51 of the brand new Income Tax Act 2025. We're going to break down exactly how this section helps businesses handle those enormous, high-risk costs that come with mineral prospecting. So, let's get right into it.
So, picture this. Your company has just poured crores into geological surveys and exploration. It's a huge, high-stakes gamble to find new mineral deposits. All of this is a massive cash outflow, right? And it's all happening long before you see a single rupee of revenue coming in. So, the big question for any tax professional or business owner is, how does the tax law even begin to account for this kind of risky pre-production spending?
Well, the answer is right there in Section 51. This is the specific tool in the Act designed to tackle this very problem. It gives businesses a way to systematically claim these costs against their future income. Honestly, it's a critical, absolutely essential tool for financial planning in the resources industry.
To really get our heads around this, we're going to break it all down. We'll start by introducing the section itself. Then, we'll get into the nitty-gritty of who's eligible and what costs qualify. After that, we'll run through the calculation, look at a practical example, cover the compliance side of things, and finally, wrap it all up with the key takeaways. All right, Section 1. Introducing Section 51. Let's start with the basics. What is this section all about? At its heart, Section 51 of the new 2025 Act lets you amortize, which is really just a fancy way of saying gradually write off, those high-risk costs of finding minerals. The whole point is to give businesses a structured way to recover these huge upfront investments over time.
Now, for all you seasoned professionals out there who know the old 1961 Income Tax Act, this is probably ringing a bell. Section 51 is the direct successor to the old Section 35E. And look, the core idea hasn't changed one bit. You can still amortize those expenses over 10 years. The main difference is really just updated terminology and how it all fits into the cleaner, more simplified framework of the new 2025 Act.
And that brings us to one of the biggest and best changes in the new Act, in my opinion. You know those confusing old terms, previous year and assessment year? Gone. They've been replaced by one single, much more straightforward term, tax year. This makes life so much easier because the year you earn the income is now the same year it's assessed for tax. Simple.
So, with that new framework clear, let's get down to business. Who can actually claim this deduction? And what specific expenses are we talking about here? Let's find out. The law is very specific about who gets to benefit. According to subsection 1 of Section 51, you have to be either an Indian company, or if you're not a company, you have to be a resident of India. And, of course, the big one, you have to be actively engaged in mineral prospecting, extraction, or production. You know, what's really interesting is how the Act defines prospecting. It's defined incredibly broadly. It covers any operation for exploring, locating, or even just proving mineral deposits. And this next part really tells you something about the industry. The law explicitly says this includes operations that fail, that are abortive, so it really acknowledges the high-risk nature of this business. Now, timing is everything. To qualify for this write-off, your costs have to be incurred within a very specific 5-year window. That window includes the tax year when you actually start commercial production, plus the 4 tax years immediately before that. If a cost falls outside that window, you just can't claim it under this section. And while this section is really helpful, it's not a free-for-all. There are some very clear exclusions. You can't claim the cost of buying the land or the mineral rights themselves. Also, and this is important, you can't include capital assets like buildings or machinery if you're already claiming depreciation on them under Section 33. That's just to prevent any double dipping on deductions, which makes sense.
Okay, so we know who qualifies and for what. Now for the fun part. How do we actually calculate the deduction? Let's get into the mechanics.
Calculating the base amount you can amortize is pretty straightforward. First, you add up all your qualifying expenses from that 5-year window. Then, from that total, you have to subtract any subsidies or grants you received. You also subtract any money you got back from selling salvaged assets or from insurance. Finally, take out those excluded costs we just talked about, and what's left is your total amortizable expenditure. So, what's the magic number for Section 51? It's a simple fraction, 1/10. Once you have that total amortizable expenditure figured out, the law lets you deduct 1/10 of that amount every year for 10 straight years, and that clock starts ticking in the year your commercial production gets going. But there's a really important catch. It's often called the lower of clause. See, your annual deduction is limited. For any given year, you can only claim the lower of 2 amounts. your 1/10 installment, or the actual income that mine generated that year. So if the mine doesn't make much money, your deduction is capped at that income. But the good news is you don't lose the rest. It gets carried forward to the next year.
Now, I know that lower of clause and the whole carry forward idea can sound a bit abstract. So let's make it super clear with a practical example and see how this all works in the real world. Let's check out this schedule for a company we'll call ABC Mining Limited. Their total amortizable expenditure is 10 crores, so their annual 1/10 installment is 1 crore. Simple enough. Now, look at the first year, 2026-27. The mine's income is only 80 lakhs, so that lower of rule kicks in. Their deduction is capped at 80 lakhs. The remaining 20 lakhs gets carried forward. Now look at the next year. Their potential deduction is the standard 1 crore plus that 20 lakhs carried forward, so 1.2 crores in total. Their income this year is 1.5 crores. Since the income is higher, they can claim the full 1.2 crores. It's a perfect example of how the deduction flexes with the mine's profitability year after year. Of course, claiming this deduction isn't just about crunching numbers. You have to follow the rules and procedures. So let's talk about the compliance and audit side of things that you absolutely have to get right.
Okay, this is a critical point for all the tax professionals watching. If the taxpayer isn't a company or a co-op society, they must get a certified audit report in Form 6 to claim this deduction. Let me be clear, this is not optional. It's a mandatory requirement.
And to get through that audit, you have to be meticulous with your records. The official guidance says the auditor will want to see everything, from audited financials and feasibility reports to every single bill and invoice for your expenses, plus detailed records of all your prospecting work. Good documentation is really the bedrock of a successful claim. The filing process for Form 6 is all done online now. First, the taxpayer gets all their data and records together. Then, they have to go onto the e-filing portal and formally appoint their chartered accountant specifically for Form 6. After that, the CA does their work, examines the records, certifies the form, and then uploads it using their own professional login. We've covered a lot of ground here. So, to wrap it all up, let's do a quick recap of the most important things you need to remember about Section 51. So here are the big 5 takeaways. First, Section 51 is all about that 10-year amortization plan. Second, you have to remember that strict 5-year window for any spending to qualify. Third, the annual deduction is controlled by that lower of rule, tying it directly to the mine's income. Fourth, any amount you can't claim gets carried forward, not lost. And finally, number 5, for certain taxpayers, that certified audit in Form 6 is absolutely non-negotiable. If you can master these 5 points, you'll be in a great position to use Section 51 effectively.
And that's a wrap. Thank you so much for watching. If you found this explainer helpful, please do us a favor and like, subscribe, and share. Just a quick reminder, this video is for educational purposes only and is not professional advice. Tax laws are always changing, so please consult your professional advisor before you take any action. This is an AI-generated educational video.